What argument am I just not understanding? Like, why isn't everyone doing this?
Not everybody needs to buy whole life insurance right off the bat. Our media does show whole life is bad. You shouldn't do it. Like, that is a big force. And I don't think a lot of people realize, like, we've been indoctrinated to think that. And until you do an actual deep dive into what's going on, who's to tell you that you're wrong?
I'm going to say something that's going to get me a lot of hate on the internet. Brock, with all due respect, I don't have the conviction that some of your clients have about giving money to my kids.
Yeah.
Does it still make sense? Brock Fortner, welcome to the BetterWealth Show.
And Caleb Williams, thanks for having me. We had to come all the way to Austin to do this show.
Yeah, we live about 30 minutes apart in Nashville, Tennessee, but we never see each other. The running joke is we see each other at other people's events.
That's right.
You've been to my event a couple times. We're actually at Justin Donald's lifestyle investor event, and we both were on a panel yesterday talking about life insurance. And what was really interesting is when we were talking about life insurance right after lunch, which is worst time to talk, and you would think on it, like life insurance, like boring topic, the energy in the room was like the highest.
Easily.
And it's not even, I'm not even biased here. Like people were very interested in learning the topics. And so I want to hear your life insurance framework. Pretend I know nothing, but I'm open. I'm like very open. I want to be the best with my money. I'm making good money. I have assets in different places. Why, like, how would you, if I'm open to listening to you, how do you even open that conversation and walk me through? Because I think this is what I need to do more.
Right.
Because I want to hear different people that have different perspectives share it their way, because that there might be something you say that clicks with someone in the audience that's maybe been watching me for 3 years. Yeah. Way Brock said it increases my conviction or clarity.
Yeah, absolutely. So I think that, you know, a lot of times when we do this marketing, it's mass marketing. So we're going to put out the best of what we can do. But oftentimes, like, not everybody needs to buy whole life insurance right off the bat, right? So oftentimes I think that when you're looking at your full financial picture, there's steps in what you need to take. Like, rule number one, are you saving at least 15% of your paycheck, right? So if you're not, like, how do we grow our income, or how do we reduce or eliminate some of our expenses that might be destructive expenses so that we can start saving? How do we have an emergency fund of at least, 3 to 6 months, right? And then when it comes to the protection, how do we get the maximum amount of life insurance first? Because if I were to ask, your wife, April, and I said, hey, if Caleb passes away today, how much of his income would you want replaced?
As much as possible.
And for how long?
As long as possible.
As long as possible. And that right there determines the amount of life insurance that we should strive for first. Yep. And I think that is where we start with term insurance. Okay. Once we then move to a place of, hey, I've got my emergency fund already built out, I'm ready to go, and I'm saving more. Like, what do I do next? Then we get into a further conversation of, all right, well, where do we house our money? Right? Because there's a big difference between saving and investing. Yeah. And before we go to any investment in this world outside of an employer 401k, it has to go to a bank account first. Yeah, right?
That's right.
And so if we are going to be investing for the rest of our life, hopefully, and we're going to continue to make more income, wouldn't it make sense for us to put money in a place that we know that it's going to continue to grow? Yeah. It's guaranteed, it's protected, and it's liquid if we need to get it. Right. So we're going to build it out. We're going to start saving money through premiums of our whole life insurance policy to build out our cash value. And as investments comes along, then we can utilize the borrowing function of life insurance to get into these assets. Because at the core, we got to talk a lot about this yesterday, is, when most people don't have the life insurance in place, they're going to continue to save money in their checking or savings account. And then as an investment comes along, they'll deplete that account. Yeah. And move it into the investment. Yep. Well, does the bank continue to pay you interest on that money when you pull it out? No. Well, what if right before we went and put it in the exact same investment, we just transferred it into our life insurance first before going to that asset? Yeah. Right? Well, when we buy assets, the hopes are it's either going to pay us cash flow, it's going to grow in interest, appreciation, and one day it's going to come back to us. Whether it's the next quarter, next month, next year, 20 years from now, like, we want it to come back to us. And it's going to go to a bank account. For me, I like investing in cash flowing assets, right? Because I want to build a lifestyle where my passive income exceeds my lifestyle expenses. And so if I know that that's going to a bank account, I might as well begin to store that within my life insurance so I can continue to repeatedly do that without interrupting the growth of our money.
Yeah, I love it. There's so many things that I want to say. Love the fact that you start with saving, even building up an emergency fund. Newsflash, you don't need your first emergency fund to be in a whole life insurance policy. There's wisdom in like put that, like let's build the muscle, and then that can eventually be transferred over to a whole life, but doesn't have to be overnight. And then love the fact that you're focused on protection and talking about, and I don't know if you said this, but like your human life value and the questions, it's like how long would I want? I would want as much money for as long as possible, regardless of who's getting it. It's like that's the example of like the value of my life from
Absolutely.
a standpoint. And I'm either going to make a lot of money while I'm alive, but if I don't, if I can have a contract that ensures that it's going to happen, like that's just another way of thinking about it. But then when we talk about like a place to store capital, it's interesting, because if you're really analytical, you can look at a high yield savings account and say, probably in the first 20 years, probably could get maybe a better arbitrage in a high yield savings account, and then take that money out and invest. And so I just play devil's advocate with me here. So the people, especially that talk about infinite banking, they almost make it sound like there's this magical arbitrage, and there's not. But then on the flip side, I'm going to kind of be in their camp for a second. There's maybe not a magical arbitrage.
Yep.
Maybe ever, but we'll just say in the first 20 years. But there's other benefits to insurance.
100%.
And if you understand the permanent death benefit, if you understand the value of creditor protection, if you understand the value of taxes, what's the tax situation going to be in the future? I don't know.
No idea.
When you start adding all those things up, Brock, we literally like that. It doesn't even hold, like nothing holds a candle to life insurance. And that's my hope, is when I get a chance to debate big name people, that I can like take them through this. Yes, I understand insurance is maybe a little bit inefficient in the first couple of years compared to a savings account. But like I want, like, what is the pitch? Like what's the pushback if someone understands the control, liquidity, they understand after the first couple of years you actually have more money than what you've put in, and you get all these other benefits, and you get actually a long-term better growth rate. So it's less of like the infinite banking people saying like there's a slight arbitrage, which can be misleading. But when you start adding in all the other benefits of insurance, there's massive arbitrage. Where am I going wrong, and why? Like, what would be the pushback if we were talking to someone that just thinks life insurance is a scam? Like, what would they be like? Oh, I've never heard of that, or what? Like, what am I not seeing, or what argument am I just not understanding that? Like, why isn't everyone doing this? That can, by the way, I think we would both agree that 90 to 95% of people need to focus on making more money and actually saving. Yeah. So like, just to be clear, I'm not endorsing this for mass strategy, but like people that can save money, like why wouldn't they do this if they're thinking long term?
If they're thinking long term, I'm not really sure why they would do it, because a lot of people, they do get hung up on the fact that first 4, maybe 5, maybe 6 years, you don't have the same amount of money that you put into the contract. But you gotta take a step back, like, okay, well, what are you comparing that to, right? Most people are comparing it to a 401k or some type of investment account. Well, if it's something like a 401k, well, you are only comparing those two in a stagnant place, which is the only thing a 401k can do, is stay stagnant and grow within the account. Whereas with the life insurance, if we wanted to, we could access and then create something else with, right? If it's an investment account, well, your head's a little skewed because this isn't an investment. Yeah, this is a savings vehicle so that you can do both. Right?
I actually think that's our trump card, because if we can't play that card, then you go down to, is there something that outperforms? You have to have, when you factor in tax benefits and all those things. But the reality is, it's an and so that creates so much more flexibility that it's not an investment. But if you didn't have that liquidity and control, we wouldn't be able to say the same with conviction what we're saying right now.
Absolutely. And I think, a lot of it does have to go to the fact that our media does show that, hey, whole life is bad, you shouldn't do it. Like, that is a big force. And I don't think a lot of people realize, like, we've been indoctrinated to think that. And until you do an actual deep dive into what's going on, who's to tell you that you're wrong, right? Everybody else is saying that you're right. This is bad, you shouldn't do it. Like, you got to actually question, what it is that you're doing.
You learned on a lot of different systems, I believe. Truth Concepts, I'm not sure if you're familiar with Circle of Wealth, but Leap is the thing that your dad was a trainer in, and you've done multiple workshops with Leap. Can you walk me through like what that is? What are some of the biggest takeaways that you've learned from Bob Castellone? But is there any like stories that you would walk through? I know that we don't have anything that you can walk through on a computer, but like there's a lot of lessons there. And I'm just curious if there's anything that we can now go 2.0, because I think we covered 1.0, but now let's go 2.0 into blowing people's mind around life insurance.
Yeah, I think, so LEAP is a lifetime economic acceleration process. That's all that I know when it comes to financial planning and how it works, why it works, and all the other not concepts, but the planning systems are from that, which is fine, except for infinite banking. And, I've spent a lot of time with Bobcat Sloan, a lot of time in the system. I use it today with all of our clients. And I think that, it's built mainly from an economic standpoint, not a financial planning system, right? So when we first understand that we all have our own personal economy and we compare it to our world economy, if we were to look at everybody's life and say, you know what, everybody just hoard every dollar that you have and just get the miracle of compound interest, our world would shut down immediately, right? So what we want to do is we want to have that velocity of money. We want to be constantly trading dollars for value, right? The more that money moves, the more value our economy has, the greater it is, the stronger it is.
Yep.
Why would it be any different for our financial life?
Yeah.
Right. So we want to always increase our maximum velocity for our money. Right. And when I think about LEAP and in my thoughts around financial planning, a lot of it is around how do we reach maximum money supply and maximum benefits at all times. And most of the time when it comes to financial planning, it's all about, how do you buy term and save the difference? No matter what way that you shape it up, most people, the default structure is how do you buy term, save the difference so that you're not putting as much money towards the life insurance, so you can have a much larger nest egg during retirement. Well, if you get all the way to retirement, you've done everything that you were supposed to, and then you cancel your life insurance, well, now that bucket of assets that you have, the money in the bank, now has to act as your life insurance and your income.
You're self-insuring.
Yeah, you're self-insuring, right? And so what that does is now you have to become, you have to be a product of safe withdrawal rate. And right now, people argue it's somewhere between 3% and 4%. But what that means is, if you had $1 million in the bank, safe withdrawal rate is 4%. Well, you can only take $40,000 out. Yeah. And so that's going to be taxable, right?
Could be, yeah.
Could be taxable. It could be, it would fluctuate with the market volatility. You don't know what's going on with inflation. You don't know what's going on with taxes. So you think through those pieces, and that is your hope is that it just works out. Yeah. And that money lasts as long as you do, and the one that you spend your life with, right? If you're married or have a partner. So the way that we look about it is, how do we purchase permanent insurance and do investments so that when we show up at retirement, we not only have investments in the bank, we also have permanent life insurance right next to those assets in the bank. And so if we can show up with a 1-to-1 ratio of assets to life insurance or asset insurance, that means we can take a more aggressive spend down rate from those assets.
When you say 1-to-1, you're talking cash value to asset value, or
death
benefit?
Death benefit to asset value.
Okay, so you're talking if you have $5 million of death benefit, you have $5 million of other assets.
Yes,
okay.
Absolutely. And so that's what we would strive for, is having $5 million in death benefit and $5 million in assets in the bank, right? Yeah. Most people would say, well, Brock, you spent money on the whole life insurance, so you have less money in the assets. Well, we were just walking through a client the other day, and I'm a big proponent. If you don't understand the concept, you won't understand the numbers, and they won't matter. And Todd Langford is the one who taught both of us that. You can show up. We were looking at one the other day. One person A showed up at retirement with $4 million in the bank, interest only at 4%, taxes at 20%, and we ran it to age 65 to 85. And then we took the same person. They had $3 million of permanent death benefit. And because for some reason, when you put money in whole life insurance, it goes in a black hole and you lose it all and don't know where it goes. He had $3 million of assets in the bank. Well, that person with the $3 million of assets in the bank had more income during retirement if taxes stayed the same or if they doubled. Interest rates got cut in half. And both times it's when you have that permanent life insurance death benefit in place that gives you the permission to spend those assets down because it's going to be replaced to the next person in line.
Yeah, let's double tap on the permission to spend. Something that you say, we have a friend, Tom Wall, who wrote the book Permission to Spend, but it was very much taken from this concept. Explain in your own words permission to spend, because I believe if people understand the power of life insurance in retirement, which you and I both hate that word, but like in the future cash flow years, it's just another reason why it's such a great asset.
Yeah.
I mean, you don't have kids and you're not married, and you put a lot of money to
a lot of money, yes, more than most salaries. Yeah.
And so like that, just people would be like, why do you do that? Well, you're doing that because you not only are benefiting today, but like you understand that for your future, you're going to be set up. So let's double tap on permission to spend.
Yeah. So let's say this, Kev, like let's say that you found out that you had a long lost uncle that just passed away. You get this letter in the mail that says, Caleb, next month you are going to get $2 million in the bank wired to you. Guaranteed. Like you know it's coming.
Yep.
Would you probably spend money a little bit differently today?
Yeah. I mean, I would, this is what I would do is I would spend money or invest knowing that 2 million is part of the situation.
Exactly. So that's the same thing when we have that permission to spend with our guaranteed death benefit is we now know that our heirs are going to be taken care of, whether that's our spouse, partner, or our kids.
Yeah.
We know.
Instead of holding on, for example, the 2 million, instead of me holding on to that 2 million and maybe not being as efficient with that, I could literally either spend it or maybe be more aggressive with it if I wanted, knowing that I have that replaced in life insurance.
Yeah. Yeah, absolutely. Because when you think about those who canceled their life insurance and all they have is their assets to spend, I mean, I've heard it's pretty scary when it's like, well, what happens if our money runs out? Like, that is your main goal, is to make sure that doesn't still make
sense if you don't care about legacy? Like, I want to be as upfront as possible. Like, there are some people that are listening to this that are like, I don't necessarily have the conviction to give money to my kids. There's a book by I think it's Bill Perkins, Die with Zero. Yeah. And his whole deal is like, hey, live it up. And I think he's a fan of annuities and some other things. So what would you say to the person that's like, Brock, with all due respect, I don't have the conviction that some of your clients have about giving money to my kids. Yeah. Does it still make sense?
I would say yes, if you want to maximize your income, because then you think about the nerdy side of it around mortality credits and actuarial science. If you know that, let's say that you show up at that retirement and you've got that permanent life insurance there, well, then you can still spend all of those assets throughout your retirement. Yep. If you have a couple down years in a row at the beginning of retirement because of sequence of rents. Yep.
So it's like, in another way, it could be a better bond.
Yeah, it could be a much better bond. Yeah. Or let's say that you went crazy. You spent all that money from 65 to 85 and you're still alive. Yeah. Well, now all those 20 years you haven't been paying into life insurance. Well, it's a contract. It still continues to grow. Well, now you can turn to your life insurance and now you have, however much in cash value to spend tax-free for the rest of your life. And at the end of the day, if, you want to give it to who knows who, then go for it.
Yeah. All right. Let's talk about some of the things that you roll your eyes at or get frustrated at on TikTok or on Instagram or on YouTube. What are some things to be careful of or beware of in the world of people talking about life insurance?
There's probably a lot out there.
Putting it on the tee for you. Don't miss.
Yeah. A lot of people have been bringing me some things lately about, I can just pay my tax bill with my life insurance cash value. I probably wouldn't go with that. Well, I can take vacations, groceries, all this. I don't veer on the side of that. Well, you're accumulating wealth. If you're going to have the cash value, use it for cash flow producing or income producing assets. Things that put money back into your pocket so that you can replenish that cash value and go do it again, right? For me, while you're building wealth, there's no reason for you to use your cash value unless you have to use it on these things that, they'll create memories, absolutely 100%, but they're not bringing money back into your life. There's no economic.
So in another way is to say it, if I want to create memories, buy cars, pay my taxes, I should just do it out of my cash flow or savings account?
Yeah, just do it out of your savings account, your cash flow.
So you don't subscribe to the people that are telling you to drive your retirement?
Probably not. No.
Okay. No. I'm just curious from a standpoint of there's people out there that are very flashy when it comes to an infinite banking, and I think that could be but it's not necessarily the insurance problem. It's mainly the behavior problem.
Yeah, absolutely. The behavior problem. And I think, right now the hot thing on TikTok, I think is, you should replace your 401k with your life insurance and this or that. It's going to be the greatest retirement play out there. Like, if you have the 401k, I'm not a huge proponent of it, but like,
you wouldn't recommend cashing it out.
I wouldn't recommend probably cashing out.
If Garrett Gunderson was sitting here and
we were talking,
what would you say to him? Because I think he would disagree with you. I think he's publicly said, and again, not putting Garrett on the spot, but he's like a 10% penalty to get your money out of the government.
Yeah, absolutely.
But I probably am more in alignment to you, unless like someone has crazy conviction. I'm like, hey, I'm not maybe as extreme on that, but I also like personally, I think you and I are in the same boat. I don't have a 401k. I don't offer a 401k to our BetterWealth. That you might think I'm crazy. I think there's better ways, but I'm not also saying like 401ks are evil. What would you say if there's other people like our good friend Garrett who's like, hey, I think you guys are crazy?
I think we agree to an extent. It's like if you're going to cash it out, have a reason for why you're going to cash it out and something that you're going to do with it, right? Don't just cash it out, just go put it in your savings account. If you're going to do that, might as well just keep it in the 401k, because then you might actually do something with it later. I think that, if you're working and you struggle with discipline, a 401k is probably going to be a good idea for you, because that might be the only thing, if you're not disciplined, that could be there to save the day when you do go to retire.
That's right. It's sad to say, but there's a lot of people that should not have control of their money, which is like sucky for me to say out loud, but for me to be delusional enough to think that everyone is going to make great decisions. And like some people should listen to other people out there and they should be forced to save. They should pay off their home, because at the end of the day, those are the things that are going to save them. But I'm also not endorsing that this is the best way. But I'm not like, I know that we live in a world that not everyone is watching podcasts like this.
And that's the other thing. Like, most people do not feed their brain what they should be. Right. They're just focused on TikTok or whatever else. And I like some TikTok, but there's a point where like you've got to feed yourself with what's going on. And somebody told me once, and this, I hope this doesn't get taken out of context, but they're like, hey, if you don't love on your money now, how's it going to love on you later? Because retirement is literally your money is taking care of you. So if you don't take care of it now while you're growing your wealth, then how are you going to expect that it's going to be there when you retire?
You have any questions for me or any things that you want to call me out on? I'm a target from a standpoint. I'm on the internet saying lots of crazy things. Anything that you're like, hey, challenge you on this, or is there any questions that you have?
No, I don't think so. I think one of the things, I keep catching myself in this, we always say, no, I don't think there's anything, but then we add to it.
It's just our filibuster way of like, let me think through this question.
Yes. So one of the things, and I think this is becoming, both of us are communicating better on this, is, back in the day, we probably bashed a little bit too hard. People like, oh, well, this guy's selling this policy because it sells a high commission, and you have to go work with somebody that's going to cut their commission as low as possible. And I think we have both grown in learning in the fact, like, that's not always the case.
Right.
Like, there are some instances where you need to or want to sell an all-base policy. Right.
Let's talk about that, because I agree with you. We at BetterWealth have sold all base policies, but we talked but in that situation, it was more an estate situation, and this person saw a ton of situations, so they made that decision, and so there's instances there. But I also, on the other side, I'm very much empathetic to we see people that are like, hey, I talked to my agent, I wanted high cash value life insurance. In some cases, they had term insurance or whatnot, and their design didn't feel optimal. And it was frustrating. And so let's talk about it, because I'm glad you brought it up. What is the framework of how designing policies, and what is the pitch for higher bases versus lower bases? I think that really is the conversation, because a higher base does pay more. And if there's better benefits for someone, it shouldn't matter. People shouldn't care what we get paid. They should want the best product for themselves. I've just found in a lot of cases that giving a lower base is like more flexibility, in my opinion. It seems like there's better growth long term, And so like those are the kind of things that I'm like, if you could show me a different way, I would love that, because we would all get paid more for quote unquote doing the right thing.
Yeah, absolutely. So when it comes to if it's a higher net worth person, it's probably better that they have a higher base because of certain tax calculations when moving things in and out of the estate per the net death benefit. But then let's say that you are a high W-2 employee.
Let's so say that a different way. So you're saying a higher estate is better for high net worth person because why?
So we probably don't need to go too deep in this. Okay. You could probably have Vince Dodona do even better on this.
Vince, you're welcome to come on. I would love to jam with you on this.
So
we'll do 1090s versus Vince, and we'll see see if I survive.
And that dude has more designations than any person I've ever met. Right? So he's in the Estate Planning Hall of Fame, like all kinds of cool stuff. But in a higher net worth person's life, we often need to remove things from their estate to save on estate taxes. And life insurance is, depending on how you put it in the estate, take it out of the estate on the trusts and take care of notes, there's a tax calculation on the net death benefit. And there's this really long word that I'm going blank on right now. And, but that is oftentimes needed and overlooked by other people because it's just like, oh, let me just sell you the highest, cash value policy that you could get. But then when they go to remove things in their estate, it causes some problems.
And again, Vince, would love to have Vince on here. Maybe the three of us jam, or maybe we bring your dad on. I have 4 microphones in Tennessee, so let's do that. The just me speaking out loud, normally the disadvantage of starting with a high early cash value, a lower base, is you have a lower initial death benefit. And then usually you have some type of term that maybe decreases. But in a lot of cases, a lot of things that we've seen is in 30 years, the death benefit's about the same. And then in a lot of cases, the death benefit actually increases because the cash value is far greater. So that's where I would just love to know is there a difference between, or is it just one of those, if you're super wealthy, you just want an initial high death benefit? And so that's and we can maybe do part 2, but I'm very much curious about that.
That's probably a part 2 because I'm still digging into it. That's things that we're still learning.
Okay, but then I interrupted you. So the next situation.
Yeah. So another situation could be, let's say that you are somebody who's putting a bunch of money in their 401k.
Yeah.
Let's say you're maxing it out, but you also are saving money other places.
Yeah.
Well, if I were to ask you, on your 401k deposits, on the money that you're depositing in your 401k, is any of that guaranteed to continue if you get disabled?
The answer is no.
No, right? So if we can take that same thing that you were sending to the 401k and create that in your base premium of your whole life policy, well, we can often acquire disability waiver of premium.
Yep.
That says, hey, the life insurance will take care of this premium.
Yep.
If in the event that you become disabled.
Do you know the cost difference between that per dollar versus just getting a regular DI policy per dollar? From an efficiency standpoint?
From an efficiency standpoint, no. But what I would say is, so on the disability insurance, you can get up to 75% of your income.
Yeah.
But most of the time when you get that disability insurance, you're not able to save any more money.
Yeah.
And if you have a family, like they need to be saving some money somewhere else.
So you're a proponent of both.
Yeah. So I'm a huge proponent of having both. So
let me say this another way. So the waiver of premium that we're talking about, usually in most companies, you can't get that on the entire premium. You can only get that on the base premium. I think there might be only one company out there that maybe allows you to do
so
both.
Base and term premium usually.
So the argument is if you're hyper-funding a policy and majority of your premium is in a PUA and a term rider, and you value the waiver of premium from a holistic planning standpoint, and something happens to you, if in this case, and I'll just say, if in my case scenario, the waiver of premium would be a lot cheaper, but would only provide, let's say, 10 or 20% of what you've been paying or contributing each year if you get disabled. And if you were to do a higher base, yes, in the earlier years, because we think we can all agree that the policy would maybe have less cash value, maybe even over time it might have less cash value, but you would be able, the waiver of premium, if you got disabled, would be able to pay that higher base. I just don't want to put words in your mouth.
Yeah. So that disability waiver of premium helps create that savings for your family. If, for instance,
I think what would be really good is for us to put part 2 on this, because I'm going to say something that's going to get me a lot of hate on the internet. Okay. I am a fan of waiver of premium, but I guess I don't value it as much as maybe I should, and we should look at it, because the way that I'm looking at life insurance, and the way that we're structuring it, there's so much high early cash value, so much flexibility, even from day one. A lot of times, if something happens, we can land the plane. So for me, it's like I would love to see the pros and cons, because I think it's an amazing point. I would just love to know, like, how valuable is it? I think we would all agree that's like, okay, but we don't do 100% base, but if we did, you could 100%. So it's like there's a balance, and I don't know if you know the balance. As I'm talking right now, I don't know the balance.
I don't think it would be tough, because every single person is different.
It's different.
Health rating, like even like the life insurance amount, like I couldn't get.
But if Vince was here, would he make the argument that he could say that's why you should do 100% base, is because the waiver of premium is
maybe?
Yeah, I mean, there is a point to say, like, if you're funding that and you do actually get disabled in year 7 and you have a paid up at 65 and you're young, that insurance company is going to pay that entire premium till age. There's an argument to be made that's incredible. So that's what's tough about this whole thing is, you could also have a waiver of premium, never use it. That's awesome. But now you created an extra drag. And so it's like, if we had a magic ball and knowing the future, we'd be able to, like, buy a ton of life insurance the day before we die and look like a genius.
Yeah, that would be awesome. And the other places that we might see a higher base is, like, if that you might be making more income down the road, and we can set your policy in a way that you do have early cash value, but that, hey, down the road, we'll probably be able to put more in. So your MEC limit, your annual payment limit, may be a little bit bigger.
You're saying not have a term rider, just do a PUA and base blend, which would most likely result in a lower death benefit than if we added a term rider to it. And you're saying long term, that would give you more options to buy more insurance, whereas a person over here may max out their insurance pretty quickly because we're doing a term rider.
Probably not. No, okay. I don't. What I was saying there is, like, having a higher base and term rider, right? If those are sometimes higher, our annual payment limit within the policy could be higher. Yeah. So if we have the availability of, like, we know that we have X amount of dollars that are going to be coming in later. Yeah. Well, then, hey, we know that we could probably take care of that, and we won't mech the policy or have to go get a new policy.
That is a talking point. Is there anyone that I can talk to that, because I know, like, there's other people that remain nameless that, like, talk about that. They're like, hey, adding a term rider to whole life insurance is like IUL. Like, they'll throw that statement out. But then when I talk to the whole life insurance carriers, they're like, you're not going to mech a policy on accident. Like, it is very hard to, like, so it's like, we almost, like, in a way, they're like, you're going to mech a policy, and it's like, man, you got to really not be paying attention, and your team can't really be paying attention. But again, like, we both don't like IUL for the same reason of creating levers. And if it would be, and the reason I'm talking is, I would love to give clients an option to be like, hey, here's the disadvantage of having earlier cash value and more flexibility. Yeah. And unfortunately, you're totally right. I am more heavy over here because I'm trying to put myself in the other person's shoes to say, what other reasons would you do this? Right. But I'm grateful for your dad and you. And, like, that's where I would like part 2 and actually document this, because there will be people to watch this to say, I love that. Yeah. They'll work with us. Yeah. We'll set it up and we'll let you make more money in the product. Like, that's like, it's not bad. And that actually is, like, incredible. Yeah. All I care about is, does the client get the best result? If the client gets the best result, like, game over.
Yeah, absolutely. And there's other instances where, like, sometimes on juvenile policies, like,
yes, I agree. Yeah.
Because they're under, you guys run on the $10,000 kind of earmark. Is like, if your premiums are so low, it's gonna take a lot of that cost of the insurance. So sometimes it is better to have those higher base premiums within juvenile policies.
Yep. And there's some people that all they care about is death benefit play, a permanent death benefit play. And if that's the case, you could go as far as to just get guaranteed universal life. Yeah. But a form of that is just all there's a lot of different ways to position this. Yeah. And that's why I think it is important to work with somebody that can understand what you're trying to accomplish and then give you different scenarios.
Absolutely. Because even in my own life, I have one policy that's all base.
Really?
Yeah. I have one policy that's really heavily funded, and then, you know, my term insurance. So,
what was the play for you in your 20s to do an all base policy?
I knew that I was going to be making a lot more money throughout my years, and I was so young that I was like, let's just go ahead and do base because I'm going to outpace this. And it still drafts from my account every month. And it's basically my emergency fund now. Like I've had it for 9 years, haven't touched it once, but it just sits there, and I know.
You have waiver premium on it?
Not that one, because I mean the premium's
$500,
$6,000 a year.
So, yeah, let's go.
Yeah. So, but my other my larger whole life policy, I have waiver premium on that one.
Brock, I could talk for a while just on all this kind of stuff. What else is on your mind from a standpoint of, as we wrap this thing up?
No, here I go again. No, I don't think there's anything.
Nothing, but let me give you something.
Yep.
Anything else that like you're seeing that you're on the internet, or things that you want to set the record straight?
I think we've covered it all of, you know, don't think that your policy is just going to magically make you wealthy.
Yes.
You know, I don't.
That's a big one.
Yeah. I believe like you shouldn't, if you're just starting out, like there's no reason for you to be using this for your daily expenses. Like this is not a checking account, right? And don't think that this is going to be, you know, oh, this is my bucket of money that I'm going to pay all my tax bills with, right?
Yep. Yeah. And mainly because you're never getting ahead, it seems.
Yeah.
Because then it's like, how are you going to?
Yeah.
The idea of buying an asset is that asset has a game plan to replenish the quote unquote bank.
Yeah.
Don't cancel me for using that word, you know. But if you do taxes, it's like you're almost like you're always working behind, so you have to figure out a way to quote unquote make that right.
Yeah. Other things that is I'm starting to see pop up a lot right now is more people are talking about, oh, just pay yourself back. Like, we're paying the insurance company back. Yeah. The interest is not going to us.
That's right.
It's going to the insurance company, and you've got to understand that.
I've never understood when in infinite banking when people say recapturing the interest. Can you explain that to me? Because I've never understood actually what they mean by that. Like so when someone says recapture interest, like, and explain to me in your own words, like what that means.
Sometimes that is a little bit difficult for me, but I think like the way that I try to think through it oftentimes is, you know, I think it's in the book, but one of the things is like using your policy for a car loan.
Yep.
Right. Well, I could see this working out if the bank is going to charge us 8% and the payment is $500 a month. But if we borrowed against the policy and the policy loan interest rate was 6% and we knew we were going to use the money anyways and we had the money, maybe we have an instance where, you know, we borrow against our policy, paid for the car in cash, but we use the dealership's 8% terms to pay ourselves. So we get that spread from the 6 to 8%. Okay. That's where I would say maybe we recapture the interest.
I think what they're meaning, and again, in the comments, please correct me if I'm wrong here, but it's the like you're just paying the insurance company, but you're paying yourself back. That's how a lot of people would say it. And instead of paying the evil Bank of America 6%, like you're paying the insurance company, which you're an owner of. And the dividend. So I think it's like, I just like the word efficient. Like long term, this is more efficient because it's just, I think, a more accurate word. But I understand on the banking terms, like recapturing, paying yourself back. Those are words that are used to simplify things. Yeah. And for that, I'm very grateful.
Absolutely.
I chat GPT'd like the top books out there on whole life insurance, and Becoming Your Own Banker was number one. I don't know if ChatGPT knows like my search history or something.
What were some of the other ones?
Woe the Rockefellers. My book made the and again they're like, hey, we know who's writing this. Pamela Yellen's book. Kim Butler's Live Your Life Insurance.
That's a good one.
And so there's a lot of other good ones out there, but it's just interesting. But going back to the number one by a long shot is Nelson Nash Becoming Your Own Banker, and I think both of you and I both 100% appreciate that man's work and what he started. Is there anything else in the infinite banking space? Because I know that we have a lot of friends, a lot of colleagues, see a lot of marketing in the infinite banking space. Like, is there anything else that you're like, hey, this is the thing we laugh about when we're talking to our friends, but like, why do you say that? Or is it just don't pay taxes and buy cars with your life insurance policy.
Yeah, I think we could probably.
You think someone could be over aggressive by funding too much in a life insurance?
Oh yeah, absolutely. Like I don't think you should put 100% of your income in the policy.
Okay.
Yeah, I like if this ought to be a savings allocation.
Yeah,
you shouldn't put 100%.
Yeah, so that shouldn't even be the goal. Is to redirect 100%.
Yeah, that's because life happens, and if you can't come up with it, well, guess what? You're in the hole now.
The reason is it's not because cash value is not great. It's because you're creating, in a lot of cases, you're creating such an obligation to fund your life insurance policy that becomes a liability.
Yeah, it is an obligation because you have a premium for at least 7 years. You want to take care of it, and there's some flexibility on how much you do or on help that you could get. But
you have a YouTube show with Nate.
Nate, Dean, and Brandon Goswick.
Okay, we'll plug that down below, and anything else that you want to plug, we'll plug below. Brock, I appreciate you, man.
I appreciate you.
Thank you for coming on the show.
Thank you.
And I look forward to future conversations. I look forward to part 2. Vince, your dad, you, and me.
I think that'll be great. And maybe we don't have to travel to Austin to do it.
Maybe we'll just travel 30 minutes to my home and let's set it up.
Yeah,
so,
we'll do that.
Brock, thank you.
Thank you.